Hello everybody, it's Chris. In this video, I want to show you how I make 25% in the stock market with a simple portfolio without complex DCF models, without complexity, complex formulas, and with low turnover. I just have a concentrated portfolio with selective stocks, with good quality stocks, and it generates 25% per year. So I will give you some tips that you can use for your portfolio and your stock selection process. I'm sure it will help you a lot. Okay, so now here is the portfolio I have for the moment. I have 12 stocks, and this is the first point I want to mention in this video. Concentration versus diversification. A lot of clients are asking me, how many stocks should you have? How many stocks, how many percentage points on each position? I would say you have a sweet spot. I have found a sweet spot in investing when you build your own portfolio. The sweet spot of how many stocks to have is between 10 and 15 stocks. If you only have 10 and 50 stocks, you focus your attention, your energy on your main ideas. And if you have 50 stocks for the opposite scenario, you will dilute your energy everywhere. Okay? So first of all, concentration has always helped me. I've been investing in the stock market for almost a decade. I have achieved a performance of 25% per year, and I have always had a concentrated portfolio. Because for all these years of reading, learning, working with legendary investors in Europe or in America, all of them shared the same idea about concentrated bets. Few bets, concentrated bets, winning bets. Because if you know what you're doing, if you do the research and you make a double in the stock market, if that's only 1% of your portfolio, it will not matter. If you make a double in the stock market and that's 10% of your portfolio, it will matter. It will have a huge impact. And now I know some people will say the reverse is true. If you have a 1% position in your portfolio and the stock gets cut in half, you will not lose a lot of money. But if you have a big position and you lose everything, you will lose a lot of money. Yes, this is why I do large due diligence on my stocks. I don't invest in anything. And actually, I don't invest in stocks where I know I have a 50% odds of winning. I only invest in companies where I have 60% chance of winning, 60%, 70%. How do you increase your odds of winning? Well, you have several filters for this. And this is my next point. You want to be invested in companies that are profitable. This is the first filter. This is how I made a fortune in the stock market. The performance has been good because I avoid all the companies that are bad and making losses. If you look at my current portfolio right now, as I'm speaking and recording this video, Google, profitable. Brookfield, profitable. MasterCard, crazy profitable. MSCI, same thing. Meta Platforms, Fortinet, AutoZone, Adobe, Lam Research, Lendbridge, Amazon, and AMR. All of them are profitable. All of them are growing revenues. All of them have been growing consistently for many, many, many years. So a key aspect of my investing style and outperforming the market has been to completely dismiss companies that are not profitable. All the genius tech companies led by a genius CEO that are investing for the future, but maybe they will be profitable in a few years, I just avoid them completely. This is fine. You have more than 50,000 stocks in the stock market. It's okay. You don't have to shoot at everything. You don't have to swing at every opportunity you have. So you just wait for your sweet spot. And when all your filters are coming together, when you find a good opportunity that fits your style, you swing hard. And this is exactly what I've been doing for almost a decade now. So I just stay in this sweet spot of high quality companies that are profitable. And when they are the good target price, I swing hard. Concentrated portfolio. The second key filter I have for all my companies, and actually all my winning companies, my best investments, are companies that are extremely simple to understand. So first, being profitable. Secondly, being extremely simple to understand. Meaning, can you pitch the investment idea to a child in 1 minute? If you can, it means it's inside your circle of competence, so it's simple enough for you. For all my companies, I can do a 1 minute, a 30-second pitch to a child with simple words. Okay? That's how you know if something is inside your circle of competence. And I only want to stay inside my circle of competence. The thing that is the most important here is not the size of your circle of competence, is the knowledge of the boundaries. You have to know where are the boundaries of your circle of competence. I know I'm not a tech genius. I'm not a genius about rockets, about computer science, quantum computers that are changing the world, solar panels, electric vehicles. It's okay. I will not have this in my portfolio. No complex companies that I do not understand. You don't need to be a genius to beat the market. You don't need to be a genius to pick good stocks that outperform the market. You just stay inside your circle of competence with companies that are profitable. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Another thing that helped me a lot is to only invest in growing companies. You grow your revenue, you grow your net income, you grow your free cash flow, and you have an industry that is growing. For all the companies I have in my portfolio, the industries they are in are growing. So a rising tide will lift all boats. And actually, a growing industry will help you as a business if you are in this industry. Because you will have this tailwind, this industry tailwind. Everybody will get helped a little bit. I can take the example with Fortinet that I have here in my portfolio in the cybersecurity industry that is expected to grow minimum 12% per year. So you can have some good confidence that all the cybersecurity companies will grow at minimum 10% per year. 10, 12, a little bit more than this every year. You can take the other side of the coin, an opposite situation with all the newspapers, all the media companies, or the cinema, theater industry. Not growing at all. Streaming is eating the world right now. So something that has helped me a lot has been to always invest in growing industries. So you want the companies to be profitable, to be growing in growing industries, something that is extremely simple to pitch. And add to this another filter that is very important, that is management teams and capital allocation. I have filled my portfolio with companies that are shareholder friendly. They think on a per share metric. They think for the benefits of shareholders. If the stock price goes down, they panic. And I want this for my businesses. I want this for my stocks. I want the management team to be focused on the shareholders. You can spot some elements of shareholder friendliness. For example, if the stock drops, the business is fine, right? The fundamentals are fine. But if for some reasons the stock is dropping, the management should step in and do some major buybacks if the stock is cheap. In my portfolio, I have a couple of examples like this. You have Brookfield that is doing this. When the stock price drops, they do more buybacks. MSCI is doing the same thing. The stock price drops, they do more buybacks. Fortinet is doing the same thing. When the stock price drops and the valuation is cheap, they do more buybacks. Doing this over the very long term will improve your performance if you only focus on companies that are doing buybacks the right way. Because you have companies that are doing buybacks the bad way. The stock is high, the valuation is high, and they do more buybacks when the stock is high. It is a mistake. They do more buybacks when the stock is expensive. And then when the stock price drops, they stop the buybacks. It sounds crazy, but sometimes we live in a crazy world. And some management teams are doing this. Why? Because of lack of incentives. And that could be a good segue for another point. I talked about capital allocation decisions. I talked about management teams that have to be shareholder friendly. Actually, you can check, and I'm doing this for all my companies. We can all check what are the incentives of the management team. How many shares does the CEO own? What is the insider ownership? I know for MSCI, Mr. Fernandez, the CEO and founder, owns roughly 3% of the company. If there is a problem, he will be hurt. And a couple of quarters ago, he bought more for him and his family. This is the largest shareholder, and he is buying every dip. It tells you a lot about confidence and incentives. Second thing you can check for companies is to check what is called the proxy statement. It's a public document online where you can check the incentives of the management teams. So what are the metrics the company has to achieve? What are the targets so that the management team gets a nice bonus at the end of the year? You will see for some companies, the bonus is tied to revenue growth. So you know that now, if they grow the revenue immensely, the management will get compensated a lot, and they will get a nice bonus, and they will buy a new mansion, a new house, a new boat. Life is good. But if that's only the revenue, if the only metric they have to focus on is revenue, you can have some pretty good guess about what they will do. The incentives will drive the behavior every time. Meaning, if a management team is only focused on growing revenues and only revenues, they can do stupid things. They can make a stupid mistake, like an acquisition, a big, large acquisition that will double the revenue in 1 year. You acquire a big competitor, so you double the size of your business, you double the revenue, and you double the size of your house. Or you double the amount of house, the number of houses you have. But it's a stupid mistake because maybe they will take on more debt to make the acquisition. Maybe the synergies will never happen. Maybe the big acquisition will create internal pressures. Maybe the acquisition will create inefficiencies. Margins will go down. Too many employees, not efficient, change in culture, different cultures, so they will fight. So many risks for big acquisition, but so much money for the CEO that will make the deal. Incentives are not aligned. So for all the stocks I have in my portfolio, all the companies I have in my portfolio, I check the incentives. Okay? For MSCI, I can tell you have a few filters. You have revenue, and you most importantly have earnings per share. They do a little bit of adjustment for the earnings per share, but this is fine. So the CEO, and he repeats this again and again every couple of weeks, the CEO is focused on earnings per share, which I love to see as a shareholder. And over the very long term, 10, 20 years, if the earnings per share of a company are growing 20% per year, the stock price will grow at 20% per year. So MSCI is focused on growing earnings per share as much as possible. I like to be aligned with my CEOs. So MSCI has a CEO that owns 3% of the company, and he's getting more paid if he grows the earnings per share. What a green flag, right? Another big thing that can happen for some companies in the stock market is that sometimes the management team owns a lot of shares. You can talk about the Meta platforms, and Mark Zuckerberg, he should own like 10 or 15% of the shares and the majority of the voting shares. You have Fortinet and the two founders that own 15% of the company. That's a lot of insider ownership. They will be destroyed if the stock price drops. You want this kind of incentives. You want to be in the same boat as the management team. You want the management team to be in the same boat as you, as a shareholder. Because if they own 15% of the company, you know they will do everything to grow their stock price in the long term. And Fortinet has been an exemplary winning stock over the past decade. If you look at the past 5 years, on the max level, up and to the right. You have some cyclicality, but up and to the right. Fortinet has outperformed almost everybody in the stock market because of incentives, because of a growing industry, because it's growing and it's still profitable. And now, I've been talking for a few minutes, you start to align the dots. All the elements are creating multiple tailwinds for the companies. I've talked about many filters: CEO, capital allocation, buybacks, insider ownership, growing industry, growing revenue, profitability. Everything adds up. And if you add all these filters, you can only spot the best quality companies in the stock market. You don't need to be invested in 100 companies. If you fill your portfolio with concentrated bets like this, of companies that fill all your criteria, that fits all your filters, you increase your chance of outperforming. And I've talked about, 5, 6, 7 filters. When you invest in these kind of companies, your odds of success are not at 50%. Your odds of success are much higher than this, because these are winning companies in winning industries, and these are winning stocks. If you fill your portfolio with 10, 12, 13, 15 winning stocks, you will have a winning portfolio. And you don't need to be a genius about valuation either. I'm just using a simple DCF formula, and it is working nicely. How can I show you? I can show you the most simple DCF model you can use. That is on Stock Unlock. By the way, I have an affiliate link for Stock Unlock. So you can go to the description of this video, click on the link and get it cheaper, because it's the best DCF model I have ever used. And I'm using this on a daily basis. So if you want to check Fortinet, you go to DCF here and you can check multiple assumptions. First of all, what will be the growth rate of your free cash flow? Let's use your free cash flow. For the past 5 years, the free cash flow has grown at 19% per year. Second metric you have to check: what is the amount of buybacks the company has done? How many shares are you buying back? On average, the company has bought back 1.6% of their shares annually. The company doesn't pay a dividend. And third metric you want to monitor is: what is the price paid? What has been the average price to free cash flow for Fortinet for the past 5 years? It has been 33, which means by default, if you go to Stock Unlock, you will have 3 metrics to put, and it will give you the 5-year average. What if the business continues to operate and at the same level it has operated for the past 5 years? If this is the case and you don't touch anything, the stock right now is trading at $80 per share. If these are your estimates and you think the future will look like the past, the fair value of Fortinet is $144 per share, which is an upside of 80%, which means Fortinet is cheap, undervalued. And if you buy right now, you can expect a CAGR, a compound annual growth rate of 23%. That's it. You don't need complex DCF models. Now, it all revolves, it all depends on your conviction. How confident you are that Fortinet will grow free cash flow at 19% per year. Maybe you don't think they will grow at 19% per year. So, okay, let's put 15% growth rate. If overall the cybersecurity industry is expected to grow at 12% per year, and then you check what the management is saying publicly, that they are growing more than the market, and it has been true for the past 20 years, maybe they can do a little bit more than the overall cybersecurity market. So maybe they can do a little bit more than 12%. Let's see if they do 15% per year. Now about buybacks. Well, 1 or 2% is what the buyback program has been for the past few years. Let's not change anything here. If you just decrease the growth rate in free cash flow, then the stock is still undervalued by 50%. And if you buy right now, you can expect a CAGR of 19%, almost 19% per year. This is it. And again, we started from a 19% growth rate. Now it is decreasing. So we are being conservative here. There is a scenario where when the cybersecurity industry grows and reaccelerates, and instead of growing 15% per year, Fortinet grows 20% per year, 22% per year. They have been doing this kind of reacceleration in the past. So it is possible. You can play around with some numbers. What if they grow 20% per year? What if they grow 22% per year? If AI is changing the world and you will need much more cybersecurity in the future. If they grow at 22% per year, your expected CAGR is 26% per year. Okay? It's better to be roughly correct than precisely wrong. I'm not putting an exact number on the exact intrinsic value because you never know what the future holds. You never know what will happen in the future. What if we have a recession? What if AI reaccelerates and the cybersecurity skyrockets in the future? What if they suddenly make huge buybacks? If you look at history, now they just did their biggest buyback ever for the latest quarter. So yeah, maybe they will do more buybacks in the future. What if they grow buybacks at 3% per year? If these are your bullish estimates, the stock is an easy double and the CAGR is 28% per year. If you buy right now, you can make 28% per year. It's bullish, but it's possible. Okay? So you can play around with some numbers and you can play around with the valuation a little bit. You can play around with what your conviction tells you. For me, I have Fortinet in my portfolio, so I have conviction. But for other people, they may have the same reasoning for other industries. And that's fine. And if you fill your portfolio with companies that are in this mold, high quality, undervalued, you increase your chance of outperforming the market. And the key here is to look at the big picture, to look at the long term of the companies. For example, when you buy something, you can make a promise to yourself of not selling the stock before 3 years. If the thesis is intact and the valuation is not crazy, you can buy and hold for minimum 3 years. By having this 3-year lockup period, you avoid the shiny object syndrome. What will be the next move from the president? What will be the next move from the Fed? What if the inflation number is bad? What if the job market is changing? This is all short term. This is not what will make you 25% per year. I have outperformed the market by only looking at companies and not looking at the Fed or what the president will say, because it's all short term. In 1 year, everything will have changed again. In 1 year, everything will have changed again and again and again and again. But what will not change is very important. What will not change is cybersecurity will still be here and still be growing. The cybersecurity industry is a young industry, like 20 years old. It's only the beginning. Do you think in the future the world will become more digital or less digital? Easy, simple question to answer. Do you think you will have more cyber attacks or fewer cyber attacks in the future? Simple question, simple answer. Do you think you will need more cyber defense or not? Simple question, simple answer. Simple, very simple. The whole portfolio thesis is about simplicity. And this is how I generated some alpha in the market. So I have given you some tools in this video, but I can't discuss everything here. If you like this kind of format, this is only 1% of what you will get inside my coaching program. If you want to go to the next level, you know where to find me. You just click the first link in the description so that we can together improve the quality of your portfolio and improve your performance. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.